In September 2008, something happened that most people alive today have never had properly explained to them. Not the simplified version, not the Hollywood movie version, the actual mechanism, what really happened, who made the decisions, what those decisions cost, and why the same structural conditions that caused 2008 exist in the financial system right now. Over the course of roughly 18 months, from mid-2007 to early 2009, the United States and global economy experienced the worst financial crisis since the Great Depression of the 1930s. The stock market fell 57% from peak to bottom. 8 million Americans lost their jobs. 9 million American families lost their homes to foreclosure. Household wealth across America declined by approximately $13 trillion. That is not a typo. $13 trillion in household wealth, gone, in roughly 18 months. Retirement accounts decimated, home values collapsed, businesses closed, communities destroyed. And in the aftermath, the U.S. government committed approximately $700 billion in the TARP program. The Federal Reserve committed trillions more in emergency lending. The total financial system support, when all programs are counted, reached an estimated $12 to $16 trillion, the largest government financial intervention in American history. Yet despite all of this, despite the magnitude of the crisis, despite the human suffering, not a single senior Wall Street executive went to prison. Not one. And 15 years later, the same financial institutions that caused the crisis are larger, more profitable, and more politically connected than ever. This video is going to tell you the full story. How the crisis built for years before it erupted, the specific financial instruments that made it possible, the regulatory failures that allowed it, the decisions that were made when it hit, and critically, what the current financial environment shares with 2008. Because understanding history is only valuable if it helps you understand the present. Let's start at the beginning. To understand 2008, you need to understand what the housing market looked like in the years leading up to it. From roughly 2001 to 2006, American housing prices increased dramatically. Nationally, home prices roughly doubled over this period. In some markets, they tripled or more. Las Vegas, Miami, Phoenix, parts of California. These markets saw extraordinary appreciation. People who bought houses watched the value increase by 50, 100, even 200% in just a few years. This seemed like a permanent condition to many. Housing always goes up. Real estate is always a good investment. These became widely shared beliefs, and this belief system was critical to what followed. Because if housing always goes up, then lending money to buy houses seems very safe, even if the borrower has questionable ability to repay. Because if they can't repay, the lender can foreclose, sell the house, recover the loan, plus profit. The rising house prices seem to eliminate the need to carefully evaluate borrower creditworthiness. The collateral was always appreciating. Or so people believed. Now here is where the financial engineering enters the story. And this is the part that is rarely explained clearly. In traditional banking, a bank makes a loan and holds it on its balance sheet. The bank collects interest payments, bears the risk if the loan defaults, has every incentive to carefully evaluate whether the borrower can repay. Because if the borrower doesn't, the bank loses money. This alignment of incentives is important. The person extending credit and the person bearing the risk of default are the same. Traditional banking worked this way for most of its history. Then came securitization. Securitization is the process of bundling many loans together and selling them as a security to investors. Here's how it works. Bank A makes 1,000 mortgages. Instead of holding them on its balance sheet, it bundles them into a security, a mortgage-backed security or MBS. It sells that security to investors, pension funds, insurance companies, other banks, hedge funds, anyone who wants to invest in mortgage payments. The investors now receive the mortgage payments from the homeowners and bear the risk if homeowners default. Bank A has transferred both the asset and the risk off its balance sheet, and received cash it can use to make new loans. This sounds efficient, and it can be when done properly. But it created a catastrophic incentive misalignment. Bank A no longer bears the risk of the loans it makes. It makes its money on origination fees. The moment the loan is made and sold, Bank A profits, whether the borrower repays or not. Bank A's incentive is no longer to make good loans. Its incentive is to make as many loans as possible, as fast as possible, regardless of quality, because it sells them off immediately. This is called the originate to distribute model, and it is what transformed the mortgage industry from prudent lenders carefully evaluating creditworthiness into a loan production machine focused purely on volume. Now, add the next layer. Rating agencies. Moody's, Standard & Poor's, Fitch. These companies are paid to evaluate the credit quality of financial instruments. They rate securities from AAA, the safest, to D, in default. Institutional investors, pension funds, insurance companies, university endowments are often required by their own rules to only invest in highly rated securities. AAA or equivalent. So for a mortgage-backed security to be sold to these large institutional investors, it needs a high rating. Here's the problem. The rating agencies were paid by the institutions issuing the securities, not by the investors buying them. If Goldman Sachs creates a mortgage-backed security and wants it rated, it pays Moody's to rate it. Moody's revenue depends on getting the business from Goldman Sachs. If Moody's rates the security too harshly and Goldman Sachs doesn't like the rating, Goldman can take its business to Standard and Poor's. This created competition among rating agencies to give favorable ratings, to win business. This is a fundamental conflict of interest. The people evaluating the quality of the securities were financially dependent on the people selling the securities being satisfied with the ratings. The result: massive amounts of low-quality mortgages were packaged into securities, given AA ratings, and sold to institutional investors around the world. Now add the third layer, CDOs, collateralized debt obligations. When a mortgage-backed security contains many different loans of varying quality, it gets sliced into tranches. Senior tranches get paid first. They are considered safest. They get the highest ratings. Junior tranches get paid last. They bear the most risk. They get lower ratings. Banks took the lower-rated tranches of various mortgage-backed securities and bundled them into new securities called CDOs. Then, the rating agencies rated these new CDOs. And many CDO tranches also received AAA ratings, even though they were made up of the riskiest portions of already risky mortgage-backed securities. This financial engineering transformed subprime, meaning low-quality, mortgages into apparently AAA-rated securities, and distributed them throughout the global financial system. Here is the part most analyses skip over. It wasn't just that these securities were poorly rated. The system required housing prices to keep rising to function. Every assumption underlying the ratings, every valuation model, every risk assessment assumed that national housing prices would not decline significantly, because they never had before, not on a national level. There had been regional declines, but not a nationwide sustained decrease in home values. So models built on historical data didn't even include the scenario of significant national price declines. This was a catastrophic blind spot. Now add leverage. Major investment banks, Lehman Brothers, Bear Stearns, Merrill Lynch, Morgan Stanley, Goldman Sachs, were operating with extraordinary leverage. Leverage means borrowing to amplify returns. If you invest $1 of your own money and borrow $30 more, you can make investments of $31. If those investments increase by 1%, you earn 31 cents on your $1. A 31% return. Excellent. But if those investments decrease by just 3%, your $31 investment is now worth $30.07. But you owe $30 in borrowed money. Your $1 of equity is essentially gone. Leverage amplifies gains when things go right, and amplifies losses catastrophically when things go wrong. Major investment banks before 2008 were operating at leverage ratios of 30 to 1 or higher, meaning for every dollar of their own capital, they had borrowed 30 or more dollars. These institutions owned massive amounts of mortgage-backed securities and CDOs, rated or AA, considered safe. What could go wrong? Now let's look at the other side of the market, something called credit default swaps. A credit default swap is essentially insurance on a bond or security. If you own a mortgage-backed security and are worried it might default, you can buy a credit default swap from someone else. You pay them a regular premium. If the security defaults, they pay you the face value. It's insurance. But here's the critical difference from regular insurance. You don't need to own the underlying security to buy a credit default swap on it. You can buy insurance on someone else's house. This meant that people who believed the mortgage securities were going to fail could bet against them, buy credit default swaps on securities they didn't own. If the securities failed, they would collect. This is what some hedge funds did in 2006 and 2007, recognizing that the underlying mortgages were terrible quality, that housing prices couldn't keep rising indefinitely. They bought enormous amounts of credit default swaps, betting on collapse. The seller of credit default swaps, in many cases, AIG, American International Group, the largest insurance company in the world. AIG sold hundreds of billions of dollars worth of credit default swaps on mortgage securities, collecting premiums, not recognizing or not caring about the actual risk. Because if the securities failed on the scale required for these swaps to be triggered, the scale of payment would be beyond what AIG could possibly cover. AIG had essentially sold fire insurance on a city without having the capital to pay out if the city burned. Now, everything comes together. In 2006, housing prices peaked, then started declining, slowly at first, then faster. As prices fell, homeowners who had bought at peak prices or who had taken loans larger than their homes were worth started defaulting, particularly subprime borrowers, people who had been given mortgages with low initial teaser rates that reset to much higher rates, or people with essentially no documentation who probably couldn't afford the loans from day one. As defaults increased, the value of mortgage-backed securities began declining, slowly at first, then faster as the scale of problems became clear. First visible crisis, June 2007. Two Bear Stearns hedge funds that were heavily invested in subprime mortgage securities collapsed. Bear Stearns tried to bail them out, failed. The funds lost nearly all their value. This was the first clear signal that the mortgage securities were in serious trouble, but many dismissed it. These were just two hedge funds. Probably not a systemic issue. The problems were contained. They weren't. Throughout the second half of 2007, mortgage delinquencies increased. More securities declined in value. Banks and investment banks started writing down the value of their holdings, taking losses. But nobody quite understood the full scale yet, because the securities were complex, opaque, hard to value independently. Banks were valuing them using models, and the models said they were worth more than the market was offering. Then 2008 began, and the contained problem became a systemic crisis. March 2008, Bear Stearns, one of the 5 major Wall Street investment banks, collapsed in days. Bear Stearns had enormous exposure to mortgage securities. As their value declined, counterparties lost confidence, stopped lending to Bear Stearns overnight. Without overnight financing, Bear Stearns couldn't operate. In a matter of days, a 150-year-old institution with $400 billion in assets was insolvent. The Federal Reserve and Treasury arranged an emergency rescue. J.P. Morgan Chase bought Bear Stearns for $2 per share. The stock had been worth over $170 per share a year earlier. Bear Stearns shareholders lost nearly everything. But the acquisition prevented Bear Stearns from failing in a disorderly way, from triggering immediate contagion. The Fed hoped this would be enough. It wasn't. This is where the system quietly shattered in ways that changed everything. Summer 2008, Fannie Mae and Freddie Mac, the two government-sponsored enterprises that guaranteed roughly half of all American mortgages, were placed into conservatorship by the government, effectively nationalized. Their losses on mortgage guarantees were too large to absorb privately. The government took them over on September 7, 2008. This sent shockwaves through financial markets. If Fannie and Freddie were failing, the scale of the mortgage problem was much larger than anyone had publicly acknowledged. Then came Lehman Brothers. This is the pivotal moment, the single decision that transformed a financial crisis into a global catastrophe. September 14, 2008, a Sunday evening. Treasury Secretary Henry Paulson, Federal Reserve Chairman Ben Bernanke, New York Fed President Timothy Geithner met with the CEOs of major Wall Street banks, trying to organize a private sector rescue of Lehman Brothers, similar to what had happened with Bear Stearns 6 months earlier. The difference this time, no buyer could be found at any acceptable price. Bank of America chose to buy Merrill Lynch instead. Barclays from the UK wanted to buy Lehman, but the UK Financial Services Authority blocked it. And Treasury Secretary Paulson, concerned about moral hazard, about the message that yet another government rescue would send, decided not to use government funds to save Lehman. On Monday, September 15, 2008, Lehman Brothers filed for bankruptcy, the largest bankruptcy in American history. $619 billion in assets vanished into bankruptcy proceedings. What happened next was financial system failure on a scale not seen since the 1930s. Lehman was deeply interconnected with every major financial institution in the world. It had counterparty relationships with hundreds of banks, hedge funds, money market funds, and other institutions globally. When Lehman failed, those counterparties immediately had losses. Their own financial positions became uncertain, and everyone stopped trusting everyone else. Credit markets froze. Banks stopped lending to each other. Even overnight, companies that relied on commercial paper markets to fund daily operations couldn't borrow. Money market funds, considered as safe as bank accounts, started failing. The reserve primary fund broke the buck. Its net asset value fell below $1 per share because it held Lehman Brothers' commercial paper. This triggered panic redemptions from money market funds globally. Institutions and individuals tried to get their money out simultaneously. The financial plumbing of the global economy seized up. Stock markets crashed. The Dow Jones fell 778 points on September 29, 2008 alone. At the time, the largest single-day point drop in history. Credit spreads, the extra interest companies paid to borrow, exploded to crisis levels. The entire global financial system was on the brink of complete failure. Now comes the government response. And this is where it gets controversial. September 2008, Treasury Secretary Paulson went to Congress, told them that without immediate action, the financial system would collapse. Banks would fail, credit would disappear, economic activity would stop. He asked for $700 billion with essentially no strings attached, no oversight, no conditions. The initial request was a 3-page document, 3 pages, for $700 billion. Congress initially rejected it. The stock market crashed further. Congress came back and passed a modified version, TARP, The Troubled Asset Relief Program, $700 billion authorized to buy toxic assets from banks or invest in banks directly. To stabilize the financial system, the Fed simultaneously launched numerous emergency lending programs, primary dealer credit facility, asset-backed commercial paper money market, mutual fund liquidity facility, commercial paper funding facility, term auction facility. The names are bureaucratic, but the function was the same: create money and lend it to institutions that were failing or at risk of failing. In total, the Fed committed trillions in emergency lending. At one point, according to a Bloomberg analysis based on Freedom of Information Act requests, the Fed had committed as much as $7.7 trillion in emergency loans and guarantees, all to prevent the financial system from completely collapsing. And it worked. Slowly, painfully, the financial system stabilized over the course of 2009. The stock market bottomed in March 2009. Banks gradually returned to profitability. The economy, after contracting sharply, began recovering, but not for everyone. While banks were being rescued with trillions, 8 million Americans lost jobs, 9 million lost homes. Median household wealth declined by approximately 40% for middle-class families. College graduates entered a job market with no jobs. Small businesses that depended on credit couldn't borrow and failed. Entire communities built around manufacturing or construction were devastated. And the recovery was uneven. Financial assets, stocks, and real estate recovered quickly, supported by Fed policies that pushed interest rates to zero and inflated asset prices. If you owned significant financial assets, you eventually recovered. If you had lost your job, your home, your retirement savings, recovery was much slower, if it happened at all. This next point is what the official history of 2008 always leaves out. Nobody went to prison. No senior Wall Street executive was criminally prosecuted for their role in creating and selling the mortgage securities that caused the crisis. Angelo Mazzillo, the CEO of Countrywide Financial, which made hundreds of billions in subprime loans, paid a civil settlement of $67.5 million. Personally, from a fortune estimated in the hundreds of millions. It did not affect his lifestyle. He was not prosecuted criminally. Executives at Lehman Brothers, Bear Stearns, Merrill Lynch, and other failed institutions lost money personally as their stock declined. But none faced criminal prosecution for what they did. The Department of Justice, under both the Bush and Obama administrations, prosecuted lower-level figures: mortgage brokers, loan officers, people who falsified individual documents, but the senior executives who designed the systems. Who set the incentives? Who knew or should have known that they were selling fundamentally flawed products to investors who trusted their ratings and due diligence? Were not prosecuted. Various civil settlements were reached with major banks. JP Morgan Chase paid $13 billion. Bank of America paid $17 billion. Other institutions paid billions. But these were institutional settlements, not personal criminal consequences, and they were paid by shareholders, not executives. In many cases, the settlements were tax deductible, meaning taxpayers subsidized them. The message sent was clear. Institutions could take enormous risks with other people's money, create and sell fundamentally flawed products, destabilize the entire global economy, and if they were large enough, interconnected enough, the government would save them. The executives would keep most of what they had earned. No criminal consequences. This is called moral hazard. When the downside risk is removed from decision-making, people take more risk. They did. The 2008 crisis and its resolution created conditions for future crises. Now let us talk about what is different and what is similar between 2008 and today. What is different? The specific product that caused 2008 was subprime mortgage securities. The mortgage market today is more regulated. Lending standards are tighter. The specific CDO structures that caused 2008 are less prevalent, so a repeat of exactly 2008's mechanism is less likely. What is similar and concerning? Leverage in the system remains high. Institutional investors are still reaching for yield in a low return environment, taking more risk to generate acceptable returns. Asset prices, stocks and real estate are at elevated valuations by historical measures, meaning future returns are likely to be lower and downside risks are larger. The financial system remains highly interconnected. A problem at one major institution can still spread rapidly to others. Government and private debt levels are much higher than in 2008, providing less buffer for a downturn. The Federal Reserve, after years of near-zero interest rates and quantitative easing, has less capacity to respond to a crisis than it did in 2008. Commercial real estate is under significant stress in 2024 and 2025, as we've discussed in other videos. This is a sector with meaningful bank exposure. Interest rate increases from 2022 to 2024 have created unrealized losses in bank bond portfolios, as we saw with Silicon Valley Bank in 2023. The specific trigger for the next crisis, if there is one, will be different from 2008. It always is. The 2001 crisis was tech stocks, 2008 was subprime mortgages, the next one might be commercial real estate or private credit, or some derivative market exposure that isn't yet widely understood. But the underlying dynamics are similar: elevated asset prices, high debt levels, interconnected financial institutions, incentive structures that reward short-term risk-taking, regulatory systems that are always fighting the last war, not the next one. What should you take from understanding 2008? Several things. First, financial crises are not natural disasters. They are not unpredictable random events. They are the result of incentive structures, regulatory failures, human decision-making under specific conditions. Understanding those conditions helps you recognize when they're building again. Second, diversification matters. People who lost everything in 2008 typically had concentrated exposure to housing through a single home purchase financed with maximum debt, to stocks through retirement accounts heavily weighted to financial stocks, to a single employer who laid them off when the economy contracted. Diversification across asset classes and income sources provides resilience. Third, debt levels matter enormously. The people who fared worst in 2008 were those with the most debt relative to assets. When asset values fell, they were left with negative equity, nothing to fall back on. Maintaining reasonable debt levels relative to income and assets reduces vulnerability to crisis. Fourth, cash is insurance. Having liquid savings, accessible without penalty or market timing, is critical in a crisis, not because cash earns great returns, because it gives you options. The ability to avoid selling assets at crisis prices, the ability to meet expenses if income is disrupted, the ability to buy discounted assets during a crisis. Fifth, understand the system. Not to be paranoid about it, but to understand how incentives work, how interconnections create systemic risk, what indicators to watch. The people who understood mortgage securities were fundamentally flawed before 2008 could protect themselves. The people who understood government and central bank responses could position to benefit as the market recovered. Information is protection. Understanding is leverage. This is general historical analysis, not personal financial advice. But understanding 2008 fully, not the simplified version, the actual mechanisms, the real decisions, the real consequences, is foundational financial literacy that every person should have. Because it happened. It will happen again in some form, not necessarily the same. But financial crises are recurring events, not once-in-a-lifetime anomalies. They happen every decade or so. They have throughout financial history. Understanding them doesn't make you a pessimist. It makes you prepared. Subscribe to Decoding the Economy for ongoing analysis of the financial system, how it works, how it fails, how it recovers, and what you can do to protect yourself and your family regardless of what the market does. This is Decoding the Economy. Thanks for watching. See you in the next one.